In today's video, we are going to be checking on a video I made the 7th of November a few months ago, where I said that we would not be having a recession, and we're going to follow up on some new charts that are showing some very, very good signs for the economy. So the first slide that we looked at in that video was that when the Fed normally pivots, you 12 months, a year afterwards, you're pretty much in the green. In so these are showing previous rate hike cycles, and then obviously the pivot. The pivot happens when the Federal Reserve starts reducing the rates. We can see here in 74, 12% up after a year. In 1980, we were up 10% after a year. In 1981, unfortunately, we were down double figures. But in 82, we were up 30%. 84, we were up 22%. In 89, we were up 12%, and in 1995, we were up 35% 1 year after the market pivoted. So 80% of the times in the last 10 times, the figure was positive, and we've got a medium and an average here of how much the market is up after a pivot happens. So this does not have to be bearish, right? So let's cover some other charts which shows us some really, really positive signs in the market. Firstly, let's go over to the S&P. This is the weekly chart. Remember, we did about a 28% downtrend. Generally, a recession happens when the market does a 29% down and two negative GDP quarter prints. We've had both of those in early 2022. Now, the Biden administration did kind of change the definition of what a recession is. So let's get it to the S&P. This has now broken its small double top that it had here. It has invalidated the double top. It is now above it, and we are about 3.6% off the all-time highs. This is not a bear market anymore. This is not a recession. Down here, you could have argued it when it was down 27%, but from the lows, we are up a very significant 33% from here. So a few more percentage points, it probably won't happen this year. Maybe early next year, we'll have all-time highs. When we do have our all-time highs, famous technical analysis saying says, show me high and I'll show you a buy. This will also increase the risk appetite for those that have missed this move. Either they'll start taking leverage or they will go into more riskier assets, including the smaller stocks like the Russell or your cryptocurrencies. Next, we will cover the Dow Jones Industrial. All of these have broken above their local double tops. This is the weekly chart. Over here, we are frankly just below the all-time highs. These are the highest candle closes that has ever happened. We have 2 days left for this candle to close. That would be the highest candle close that the Dow Jones Industrial has ever had. My friends, this is not a bear market anymore. We are down from the all-time highs. Let's see. I mean, there's still a few weeks left. It's less than a percentage point over the all-time highs. It's slapping on 1% here. So we might actually see the all-time high in the Dow Jones Industrial this year, if not very, very early next year. So the next chart we will take a look at. The next chart we will take a look at is the Nasdaq. We had this falling wedge with a breakout target well above the all-time highs, a measured move of 3,530. Also invalidated the double top by breaking above it. This is a strong weekly candle heading up to the all-time highs on technology sector. We are off the all-time highs at minus 2.4%. We go over to the comments on this chart. Some very, very nice comments, but some very nasty comments. Listen to this, guys. If you listen to this, guys, You are about to get wrecked so bad it's not even funny. My friends, we are up higher since this video was made, up significantly higher. If you missed the boat, and many bears are still on the sidelines. Not only that, there are massive, massive amounts of cash on the sidelines that are sitting in bonds. Right, as the bonds start moving lower and their yields start reducing, that smart money needs to get out of bonds and start going into risk assets. The United States 30-year bond yields percentages are going down. This is good for risk assets as fund managers need to get into stock as the stock market is outperforming their safe bets where they're getting a small yield. Not only that, the prices of the yields are rising steadily. This chart over here is US oil. Now, when crude oil goes down, it is literally an instant stimulus for not only the US, but the whole world, as all products needs to be transported. Many products are built with oil, including your plastics. So this is breaking down below 68. As soon as you get below 77, it will cause a very nice spike in your risk assets, and we can see how the S&P and all the other indices have rallied off very, very good stimulus from the drop in the US oil. As we head into December and next year, what is called the December bonus round is also happening. This is when fund managers sell stocks that are not performing and they go into stocks that are, so that their portfolios look very, very nice and they can get their end of year bonuses. So they really want their bonuses, and this market is going higher from here. This is Apple, the big daddy. Apple has a large market share, right? This has made new all-time highs where most haven't since their tops in January of 2022. So the Apple is up much, much higher at 198. This is a small little double top formation breaking here. As soon as we break above this, expect it to go much higher. Show me a high and I'll show you a buy. Apple having a large market share, leading the rally and showing lots of strength here as well. This is very bullish. There are a few other situations that are giving the risk assets some tailwinds, pushing it higher. This is heating oil. And we can remember all of the bad news about a year ago that Europe is going to freeze, etc., etc. All of the bad news happening literally at the top of the price ranges. This is generally what happens. You will hear all the bad news at the bottom of the market, and you will hear an infinite amount of good news at the top of the market. You can see here that heating oil has pulled back significantly in the last year, making a low earlier in this year, rallying, but now again pulling down. We are at 70 on this chart. When heating oil goes down, obviously households don't have to spend that much, and it is winter in Europe, so it won't get much higher than this as we get further into the season and into summer after that. Another strong stimulus for the market is natural gas. We can see here natural gas is literally back at its lows, heading a high in August of 2022. It's just been down from there and looking very, very good for the markets over here, as this is an infinite or an instant stimulus for the market. Over here we have the Bloomberg Commodity Index. This shows us commodities are a good representation of what inflation might be doing. This is the weekly chart. This now is a significant breakdown of support. You can see there's no more support left here, and we have lost a very, very important level for the bulls. This is trending down. Maybe we retouch the 97 area before trending lower. There's lots of downside here for commodities to go down a little bit more. Let's see where our next support level might be for your commodity index. So we've now fallen below the 50%, which is a very important GAN level. It coincides with that breakdown level. Then we have the 61.8 year, which is the golden ratio at 88. Maybe that holds, maybe not. But at the end of the day, this market is going lower, making raw materials much cheaper to create products, etc., etc. So this is trending down. This is very bullish. Let's check out the BTC chart just to finish this stream. We have come all the way to the 50%, now rejected. Now the market is expecting this to go all the way to the 48,000. Everybody and their mum is looking at this level. We haven't really collapsed as of yet. This could be a top forming here, right? But this isn't really a topping structure where this was higher highs. Generally, you get lower highs before a sell-off. Let's put up some indicators here to see if they are coming down. So they are coming down pretty slowly. The faster moving average, the Willy here, is almost at 50%. The RSI is coming down nicely. There were lots of bearish divergences at the top here. So either we kind of move sideways here before another leg higher. I really think that these higher levels need to be hit. And in fact, the 61.8 has been hit in previous cycles, as I've pointed out in previous videos as well. With that being said, this is your macro update. Part 2 of a no recession, right? Not clickbait at all. I've shown you guys the data. We do not listen to the news. We check out the data first. The data and the charts will tell us the news way before it happens. With that being said, do click the video. Check out the links in the description. If you would like to support my work and make sure I can make more of these in the future, do check out the Patreon in the link in the description down below. Thank you for watching this video. I hope you learned something, and I'll see you guys in the next video. Cheers for now, and bye-bye.